As we enter 2023, the stock market is facing significant uncertainty due to a combination of economic and geopolitical factors. Even after bouncing off their October lows, stocks ended 2022 down significantly, and market watchers expect more of the same in 2023. With the Federal Reserve set to continue raising interest rates and the U.S. economy yet to enter the much-expected recession, investors are sitting on a lot of uncertainty, which is likely to fuel volatility in the market in 2023. According to Greg McBride, CFA and Chief Financial Analyst at Bankrate, 2 and 3 economists are forecasting a recession in 2023, yet corporate earnings estimates haven't come down to reflect that. If the economy continues to slow and quarterly earnings calls in January reveal a bleak outlook for the year, corporate earnings estimates will likely be marked down, leading to a renewed tumble in the market. One key area that investors should be watching in 2023 is interest rates. The Federal Reserve has indicated that it may slow or stop rate hikes, likely in the first few months of the year, which marks a significant shift in policy. The rapid rise in interest rates in 2022 has led many analysts to expect a recession in 2023. According to David Keller, President and Chief Strategist at Sierra Alpha Research, 2021 was a bull market driven by Fed liquidity. 2022 was a bear market driven by Fed liquidity. Don't fight the Fed will continue to be good advice in 2023, with the first half of the year likely weaker based on the Fed's ongoing efforts to fight inflation. In addition to the impact of interest rates on the market, investors should also be aware of broader geopolitical concerns, such as events in Ukraine and weakening economic data in China. These factors, along with the ongoing uncertainty about the economy, mean that there's still a lot of uncertainty out there right now, according to Dan Raju, CEO of Tradeer, a brokerage platform. Given the uncertain market outlook, it's important for investors to think long-term and consider diversifying their portfolio to mitigate risk. While some sectors, such as value stocks, may perform well during a downturn, others, such as growth stocks, tech stocks, and cryptocurrencies, may continue to struggle. According to Kunal Sawhney, CEO of Kalkin Group, an independent provider of stock research, this year saw growth stocks, tech stocks, and cryptocurrencies take a beating. He expects 2023 to progress on a similar path until recovery begins. However, it's important to note that individual pockets of the market may still do well despite the larger economic malaise. For example, sectors such as healthcare and consumer staples may be more resistant to economic downturns and could provide a safer investment for long-term investors. Another factor to consider when investing in 2023 is corporate earnings. With many analysts expecting a recession, it's important to pay close attention to how companies are performing and their outlook for the future. If earnings come in lower than expected or companies provide a bleak outlook, it could lead to a further decline in the market. In addition to keeping an eye on corporate earnings, it's also important for investors to keep an eye on the Fed's posture on interest rates. If the Fed decides to slow or stop rate hikes, it could signal a turning point in the market. Until then, it's likely to be more of what drove the market in 2022. As mentioned earlier, diversification is key to mitigating risk in a volatile market. This means spreading your investments across a range of asset classes, such as stocks, bonds, and cash, as well as within each asset class. For example, within stocks, you might consider investing in a mix of domestic and international stocks, as well as stocks in different sectors. It's generally a good idea to diversify your portfolio across different segments of the stock market to mitigate risk. Large cap stocks, these are stocks of well-established companies with a market capitalization of $10 billion or more. Large cap stocks tend to be less risky than smaller companies, but they also tend to have lower potential returns. Mid-cap stocks, these are stocks of companies with a market capitalization between $2 billion and $10 billion. Mid-cap stocks offer more potential for growth than large cap stocks, but they also tend to be more volatile. Small cap stocks, these are stocks of smaller companies with a market capitalization of less than $2 billion. Small cap stocks tend to be riskier than larger companies, but they also have the potential for higher returns. International stocks, these are stocks of companies based outside of the United States. Investing in international stocks can provide diversification to your portfolio and potentially higher returns, but it also carries additional risks, such as currency fluctuations and political instability. Sector-specific stocks, these are stocks of companies within a specific industry, such as healthcare, technology, or energy. Investing in sector-specific stocks can be more risky than investing in a broad-based index fund, but it can also offer the potential for higher returns if the sector is performing well. It's important to consider your own risk tolerance when investing, as this will help you determine the right mix of investments for your portfolio. If you're a conservative investor, you may want to consider investments that are less risky, such as bonds, while more aggressive investors may be willing to take on more risk in exchange for the potential for higher returns. If you're not comfortable making investment decisions on your own, or if you just don't have the time to manage your portfolio, you may want to consider working with a financial advisor. A financial advisor can help you determine the right investments for your goals and risk tolerance, and provide ongoing guidance as your needs and circumstances change. Keep an eye on the macroeconomic picture. It's important to stay up to date on economic indicators, such as GDP growth, employment rates, and inflation, as these can all impact the stock market. For example, if GDP growth is slowing, it could signal a potential recession, which could lead to a decline in the stock market. Finally, it's important to remember that the stock market can be volatile in the short term, but it has historically delivered strong returns over the long term. This means that it's generally a good idea to stay invested, even during times of market volatility. By staying invested, you'll be able to take advantage of any market recoveries and potentially earn higher returns in the long run. Overall, 2023 is shaping up to be a volatile year for the stock market, with a number of economic and geopolitical factors at play. It's important for investors to keep a long-term perspective, diversify their portfolio, and pay close attention to corporate earnings.